To our medical heroes and heroines who stand against a virus ravaging our country, we see you. Thank you for every ounce of energy you summon, even when you're running on empty. We at PPS know that when we emerge victorious as a country, it will be because of the dedication, care, and love that you put into your work every day. PPS, marking 80 years of being there for professionals. PPS is a licensed insurer and FSP.
Warren Ingram, he is a personal financial advisor, executive director at Galileo Capital. It is that time of the year again, Warren Ingram, where people start going pale and running around and panicking because they've not kept their financial affairs in order. They've not been keeping a good eye on their income and expenditure. They are a little bit slack, hate forms, and are thinking, oh my goodness gracious me, I've got to do my taxes again. And they get into a bit of a state. Is there any reason to be in a bit of a state?
I'm not sure about being in a state. I think that one should feel a little bit motivated right now to take advantage of all of the, well, not all, but the very few nice tax advantages we get as taxpayers. Nowadays, there are not many ways for us to legally avoid paying tax, and to get any kind of benefit from SARS is very difficult. And so, people who haven't taken the full benefits that are on offer, I think they should be feeling a bit of pressure now to get their house in order and get these advantages as fast as they can.
No, I mean, these advantages are, and governments don't like to look after people in their old age. They'd like to look after as few as possible. And they want to encourage you to be able to look after yourself in your old age. And I suppose one of the most obvious things is ensuring that you're maximizing as much as you possibly can afford any sort of pension payments that you can make in order to, one, boost your savings over a longer period of time and build some nice momentum and get some nice compounding growing in a pension fund. At the same time, reducing the amount of money that you need to pay tax on.
Absolutely, and I think there kind of been quite a lot of debates in the last few years in the media about retirement funds, whether we should contribute or not, because government's going to nationalize the funds and through prescribed assets, and it's all going to go into the black hole of Eskom and Transnet and the like. And I think that's caused a lot of damage to the retirement fund savings of people, because people have either just cancelled contributions or reduced them as much as possible. And I feel that as time goes on, we're starting to understand that it would be really nice if we could just get an official statement to say that's never going to happen. But what we're hearing more and more from various people within government and the ANC is, prescribed assets is off the table. In which case, people should really reconsider their views on contributing to retirement funds. At the moment, we're allowed to contribute up to 27.5% of the taxable income that we earn every year to retirement funds to get a tax benefit. And yes, for people who really earn a lot of money, pretty much all the cabinet ministers, they're only allowed to contribute to a maximum of 350,000 to retirement funds. But the point is that money that you contribute to retirement fund, it reduces your tax by a lot. And secondly, you now start getting tax-free savings on the money that's inside your retirement funds. What do I mean by that? A retirement fund pays no income tax, no capital gains tax, no dividends tax. So while the money's inside, it's growing as fast as possible without any kind of friction from tax. And so to me, that's a very significant advantage that we should be taking now as taxpayers. If you earn rent or you earn interest, obviously if you earn a salary, if you earn contract income and the like, this is something that you should be doing to build up your financial independence. As you say, we can't really rely on a state to do that for us. We need to do it ourselves, and this is one very effective way to do that.
A lot of people find it very, very offensive, however, though, that you have to comply with Regulation 28 of the Pension Funds Act. And that is a requirement that says that a maximum of 30% of your investments can go outside the country, can go offshore investments. The vast majority has to be tied up in South Africa. And one of the reasons why people have got so allergic to this idea of putting money into pension funds or into retirement annuities is that South Africa's performance has been so abysmal for so long. Yes, we bounced last year. We've had a lickety-split start to 2021. But the nature of many South African investors is one of immense negativity towards South Africa and the JSE.
I've never heard lickety split as a way to describe investments. That's fabulous.
Write it down. Use it. You'll make money.
I'm going to steal it if you don't mind. Yeah.
Of course.
So I think a couple of points. One, the rand hedging aspect of retirement funds is a big issue. But just to understand, you can use your 30%, as you say, within the retirement funds. And then if you look at, a large chunk of the JSE itself is also rand hedged. If you look at companies like Richmond and Naspers and British American Tobacco and Anglo's, Billiton, Glencore, they earn, AB and Bev is the other big one I'm thinking of at the moment. And they earn the bulk of their money outside of South Africa. And largely, in one form or another, dollar-denominated income. So I think when you look through the average retirement fund, you probably find that about 50% of that fund is rand hedged in one way or another. And as emerging markets start to come back in favor again, that's why we're seeing that lickety split start to the year. Is we're seeing the interest in all emerging markets picking up, and that's helping the JSE and obviously the rand. So yes, we have got a limitation, but truthfully, I'm seeing more and more fund managers now, South African fund managers, starting to downweight their overseas allocation in favor of South African assets. So in other words, the fact that they're allowed to send 30% out, they're actually below that. I've seen sort of 25, 28% levels at the moment. So what it's telling you is that the professionals who have the scope to go further are not. They're actually, in fact, saying we see better opportunities elsewhere. That's an important thing to understand. And when you talk to these fund managers, and not really about a moment in time, but you say to them over a decade, what sort of allocation would you have for a South African resident? A lot of them would say that 30% number is close to optimal. Maybe it should be 35, maybe it should be 40, but they're not saying it should be 70% offshore. So yes, that's a concern, but I don't think that's the reason to avoid retirement fund contributions, because the tax benefits actually outweigh that issue of the offshore capacity.
Okay, I mean, that's important, because a lot of people are going to say, look at this and say, you know what, I've been reading, I've been listening. The Briar conversations are all about, just pay the tax. Pay the tax. If you owe SARS 100,000 Rand in tax, in order to get that as a benefit, or in order to zero that, you need to invest 150,000 Rand in an RA. Rather pay the tax. Take the 50,000 that you would have put of the 150 you would have put into an RA and put it offshore. Put it anywhere. Just don't keep it in South Africa, because nasty government is going to steal it from you.
And if you are really concerned about this issue, and you say, well, look, I can't bring myself to maximize my retirement capacity, then by all means, reduce your capacity somewhat. Still make the contribution, still get the tax advantage to a point. And then at least invest another portion of the money, outside of your retirement fund that builds up your offshore allocation. And I think that's the point: is you shouldn't view your retirement fund as your only saving or your only form of investment. If you want to get more offshore, there are other ways of doing that very efficiently.
Okay, let's talk about tax-free savings accounts. This is after-tax money. So this is money that you've got in your bank account. You've done your retirement annuity, and now there is hopefully a little bit of money left, and you talk about boosting other investments. So, these tax-free savings accounts, the world's most misnamed investment opportunity. Talk to me about that.
Well, I think so just to explain the structure very, very quickly, you're right. You don't get a tax benefit from SARS for making a contribution. However, every cent that you put in there is going to be completely free of tax while the money's invested and when you take it out one day. So while you're making these contributions, the money will grow, and you'll pay no dividends tax, income tax, capital gains tax. And then one day when you decide to draw the money out and it's grown and doubled again, you pay no capital gains tax or any other form of tax.
Such an optimist. You're such an optimist.
I am. And the only things to know about this is that you're only allowed to do 36,000 Rand a year as a contribution. You can't do more than that. and you've got a lifetime allowance of 500,000 rand. And that's an important thing to understand, because money that you put in, you can't draw out and then say, well, hang on, I grew my investment to 400,000. I needed 100,000 for a car, but I've saved again. Can I add the 100,000 back? Unfortunately, what you take out, you lose. So that's an important thing, just to say that it's a great investment. It's completely liquid. In other words, if you made the contribution now and you needed the money in 3 weeks' time, you can access it. There are no penalties. You won't pay taxes or anything like that, but you are going to lose the capacity. So it's an ideal long-term savings investment. And then just to understand, you're right, it's got a terrible name. So people think that it's can only be for bank accounts and fixed deposits and the like. That's not true. You can buy anything from a fixed deposit right up to shares to a global ETF, and that's really my point around.
So, but here's the great opportunity. So you're not taking your rands and converting them to dollars and then finding an account offshore to put the money into. You're keeping your rand in South Africa. This is a South African investment. You're putting your money in South Africa. You're keeping it in South Africa, but you can buy with a tax-free savings account assets offshore. So if you're worried that your retirement annuity is not giving you enough offshore, you can take cash and get that exposure internationally in South Africa.
Exactly right. And I think, and it can be anything from quite a narrow, sort of very specific kind of an index. If you just want to, I'm not recommending it. I think it's a bad call now, but you could buy a tech index. You could buy a global, world stock market index. You can buy a global unit trust that's managed by fund managers, balanced funds and the like. So you've got a massive range of options there. And I think these two investments work very well together. So for people who say, look, I hear your arguments, but you're not going to convince me to put every cent of my savings in retirement funds, then what I would say is do at least one for one. Make sure that you're getting the capacity from retirement funds. You are using it, but also that you are topping up your tax-free savings. And if you've got 6,000 rand a month to save, please, fill out your tax-free with 3 a month, and then do your retirement fund with 3 a month. If you've got more than that, obviously you can't do more in the tax-free. Then keep going in your retirement fund until you hit that cap. But the point is, these are the two big ones I think that get offered to us every year. The two big opportunities that we get from SARS. We don't have many. And if you haven't used your capacity in your tax-free, then now's the time. You've got a few days left. The tax year end is the end of February, and please don't wait. I can't tell you how many times I get emails from people saying, I made the contribution on the last day of Feb, and surely it counts. The money must reflect in the investment company's bank account. So don't wait. Yeah. Don't leave it to the last second. The same applies to retirement funds. So get it done now. Get it out of your hair. Take advantage of the opportunity. And if you want this mad rush to disappear, then beginning of March, why don't you just maximize your tax-free savings there and then if you can, and get the money compounding in your favor as fast as possible, so it can get that doubling I was talking about.
Can I stress the importance of phasing in payments on retirement funds? Just a personal experience a while back. Despite the lessons of the great Warren Ingram, somebody I know, May last year, 2 weeks before markets crashed, have topped up their retirement fund and have just watched money evaporate rather than saying phase it in over time. Apparently, that's the right thing to do.
It's whoever told you that's a smart person. I think that's a great advice. I think the one comment though, just to counter back to that, if you haven't done the contribution to the retirement fund this year, don't now say, hang on, they just said I should phase in, so I'm not going to maximize my retirement fund contributions. If you've missed the boat for this whole year of contributions, then please do the top up anyway, because the likelihood of the market crashing again, at the beginning of March, it does exist. Of course, anything can happen, but I suspect that's not the big issue. So yes, rather do a debit order. It makes much more sense.
Yeah,
to your retirement funds and your tax frees. But if you haven't done it this year, still take advantage and then set the debit order for next year.
Okay, cool. Jeff wants to know, I want to get to Jeff's question in a moment, whether it's a good idea to start investing offshore. Because you've been talking about lots of investing in South Africa, and Jeff's getting a little bit perturbed about this, getting maybe a little bit confused. Let's pick up on that one in a moment.
The Money Show. Personal Finance with Warren Ingram.
So Jeff's question, I'd like to start investing in shares overseas. Is this wise? Not ETFs, not unit trusts. Start investing in shares overseas. That is the question. Answer the question, Warren. Answer the question.
It's amazing the timing of the question. So I sit in the back of my head thinking, I wonder if Jeff's been following what's been going on in the world of Reddit and American shares, where we've seen a few very small companies in America going, their share prices going through the roof, driven by private investors, largely through forums on Reddit where they've just been promoting the shares to each other. And then all of a sudden, the share prices collapse, which they have to do because they were driven up through the roof beyond their value. So I'm hoping that that's not why Jeff wants to start investing in shares overseas. But so kind of big picture, very quickly. Big picture, I think overseas allocations for South Africans make sense. I think all of us over time should have at the very least about 25% of our assets invested overseas. But for most people, I think the number should be closer to 50% in South Africa, 50% overseas. And so, the very wealthy who might be leaving money to their children's children, that number can go up to 75% overseas. So should you invest overseas as a principle of, I think so, no question. Should you be buying shares? I think I would say I would have the same hesitation as you can hear I'm having now with South African shares. I think the point is, being a share investor makes a lot of sense. You can make a lot of money, but it does come with a heck of a lot of risk. And what are the risks? Well, you can buy, the Steinhoff, in overseas. You can buy the Enron, which went nowhere, and you can buy GameStop, which exploded and is now falling apart again. And so the thing to understand about shares is, if you're going to do that, you have to do your homework. You can't buy based on what your friends are telling you in social media, based on what you're hearing about around the famous Bri or my dangerous hairdresser. You've got to make these decisions based on solid research that you've done in long-term investments that fit your overall financial position. In other words, it's money you can afford to invest. You don't need it right now. You can let it grow for 5 or 10 years. And if that's the case, then potentially, overseas shares are right for you. But I think for most of us, and I'm including myself in this, we're not great share pickers. We might get the decisions right to say, well, let's get our allocation to shares as an overall, in our whole portfolio. Let's push it from 15% to 60% or something like that. That overall big decision can make sense. We can say, let's buy emerging markets because they look better value than America, for example. But to say, I can pick the 5 shares or 10 shares that are going to do better than all the other shares and all the other indexes in the world, that's a really tough thing to do. So am I discouraging you? In principle, no, but I am saying, Jeff, you've got to do a lot of work, and don't just rely on 30 seconds of research based on a tweet or a Reddit post. That's really not going to help.
We've got lots of questions coming through on terminology, but I think today is a good opportunity, and it feels a bit like a silly question, but I think it's an important one to ask, because we talk about this term rand hedge all the time as if it's like talking about oxygen or water or other sort of daily essentials or food. Everybody knows what it means. Talk to me about what the term rand hedge means.
So rand hedge investment is something that gives you protection against the rand itself. So the rand dollar exchange rate getting worse. In other words, you buy, let's say you buy your investment today, and it is a rand hedge. So you're buying it, and that means that somewhere along the line you're going to be using rands that are going to be converted from rands into dollars. I'm just going to use dollars because it's the global currency and it's easy for me to remember the values. So you're going to buy it at 15 rand as the exchange rate today. And then let's assume that in a decade's time, the rand is trading at 30 rand to the dollar. That means that if you bought a rand hedge investment, you've benefited from the rand basically, losing half of its value. Or when looking at it the other way, you've doubled the value of your money in rands, because that's what's happened. It's gone from 15 rand to the dollar to 30 rand to the dollar. So typically how these work is, it can be, let's say, a share on the JSE, it can be a rand hedge. So, and my favorite example of that would be a Richemont. It does very little business in South Africa. It sells, luxury goods all around the world, and mostly, in a variety of currencies. But ultimately, what happens is you're going to get that investment. You're going to buy it on the JSE here with rands. But as Richemont trades around the world, and it doesn't really trade on the JSE, its primary stock exchange. It trades on international exchanges, especially in Europe. You're going to benefit if the rand starts to get weaker. And so you're hedging your bets against the falling rand on one side, and then on the other side, you're taking advantage potentially of a company that is going to sell more stuff in hard currency, in non-rands around the world. So that's the one way of rand hedging your investment. The other would be to buy, for example, we were talking a bit earlier about exchange traded funds. So you can buy an index. You can buy it with rands, and it will usually be called. So it's got a terrible name, but they're called feeder funds. And so what will happen is you'll buy, let's say, the world index on an exchange traded fund provider or on the JSE itself, and it will be 100% in rands because you're going to buy it with rands, and when you sell the investment one day, you're going to get your money back in rands. But that entire investment will go overseas and will be invested in a global index that will be dollar denominated. And again, if the rand goes from 15 to 30, you're going to benefit from that, and then you're going to benefit from any growth in the world stock markets over that time frame as well. So you're now hedging your risk away from the JSE itself and away from the rand weakness. The last way would be, well, not the last way, but another way would be feeder unit trusts, feeder fund unit trusts, which would do very much the same thing, but instead of an index, it will be a portfolio. It could be a global balanced fund or global equity fund, and you would do the same thing. And then I guess the last way would be more direct. In other words, you say, I'm going to actually physically take my money, go to an exchange, foreign exchange place, convert my rands into dollars, and then use those dollars to buy investments overseas directly. That's the last, ultimate form of rand hedging, where you actually convert the money out. A bit more expensive, a bit more cumbersome, because you've got to deal with SARS and Reserve Bank and all of those things. So most of us who are saving on a monthly basis or with smaller lump sums, we're gonna go the rand hedge route of either exchange traded funds or shares.
Thank you. Warren Ingram, Galileo Capital.